Hello. Thank you all for joining us this morning. My name is Ethan Lau, and I'm the Chief Content Management Officer here at MYTHEO. MYTHEO is registered and approved by the Securities Commission Malaysia to help investors like you build your personal wealth. Our digital platform uses AI and algorithms to identify investment opportunities all around the world, so that you can diversify globally, all within just a few taps on our apps. So if you have not already done so, go ahead, download MyTheo's app or log on to our website to find out more. All right, so what we're going to do in the next hour is to talk about investing in ESG. What is ESG? How is ESG investing different from other investments? Why are fund managers, investors all around the world talking about ESG investing today? Joining me to make sense of all this is Matthew Stuart-Box, Chief Investment Officer at MYTHEO. Matthew is, of course, the main architect behind the development of MYTHEO's algorithm, and he also oversees portfolio management and trading at MYTHEO. Matthew, thank you for joining us today. How are you doing?
I'm fine, thanks. Morning, Ethan. How are you?
I'm doing good. Great. So let's kick off with a poll. Let me just quickly show the poll questions. So what we're basically asking is this: which of these concerns about ESG investing that you may have today? Feel free, let us know. Okay. All right, so let's see the responses. Matthew, so I think 50% of our attendees are worried that financial returns could be sacrificed with ESG investing, followed by perhaps too early to judge ESG performance. Very interestingly, ESG funds excluded energy and other sin stocks, and of course, with unsure and not applicable with the rest. But none seems to be thinking that ESG is just a temporary fad. So Matthew, based on these poll responses, perhaps you can first help us understand what is ESG investing.
Sure. I think I can maybe explain a bit of the background about what ESG is and how we approach ESG at MYTHEO. ESG, so obviously it stands for environmental, social. Trying to evaluate companies not just on their profitability, not just about how they maximize profits, but also about how they incorporate social goals into their business. And a lot of people think of ESG as a kind of a third dimension to investing. And I think that's a very good way of thinking about it. Traditionally, you have two dimensions, a financial return dimension and a financial risk dimension. And those are both very important. They're very important. But the fact is that a company is part of society. A company exists in society and it has an impact on society. And in that sense has an element of social responsibility. So their social activities is a fair way, I think, of evaluating companies. And so that's that's the approach that we take to investing in ESG.
So Matt, this is quite similar to what we already heard about, the three Ps: the people, the planet, and the profitability. Yes. I see.
Yes.
Okay. So what is the evolution of ESG investing? Why is it so? We have heard so much of more recently.
Yeah, sure. I mean, ESG, it has a long history. This isn't something that's just happened recently. You can trace the roots of ESG investing way back into the 19th century. Faith-based investing, where people were investing based on their religious convictions, their religious beliefs. That gradually developed through the 20th century, and in particular, an element of exclusion screening, removing so-called sin stocks from portfolios. And that would mean, excluding alcohol-related stocks, perhaps gambling stocks, maybe stocks related to weapons, things like that. That was maybe during the 1970s, 1980s, and so on. From there, it evolved more into a more positive approach, not simply excluding bad stocks, but positively overweighting or positively focusing on stocks or companies that have a positive contribution to society, and that's a perfectly reasonable approach. Recently, I think the reason why people have become much more have heard much more about ESG recently is this idea of ESG, integrating ESG into a mainstream investment approach. And so this is an approach that many managers now take, as well as looking at the traditional two dimensions of return and risk, also looking at this third dimension of responsibility. This means that ESG can be incorporated into a far wider range of investment strategies, things like that. And I think that's perhaps why we've started to hear much more about.
Matthew, can you? I think we lost you a bit there, but not to worry. So I think what we understood here is that ESG shouldn't be seen as a standalone, a different sort of investment approach, but it has been integrated in how business operates more today.
That's correct, yes.
Okay, so according to reports by Reuters and a few others, 2021 was a record year for ESG investment. In fact, estimates put it that it more than doubled that of 2020. The pandemic surely didn't stop ESG down. I mean, why are investors increasingly pivoting towards investments in ESG?
Yeah, sure. So it's true that it looks like 2021 was a very strong year for ESG inflows. But to be honest, ESG has been growing well for the last, 5 or 6 years. And maybe if we look at some of the drivers of that growth, we'll get a better understanding, I think, of why it's been growing. This is some data from the Sustainable Investment Institute, which looks at total ESG assets around the world. And obviously, there's different ways of measuring the total number of ESG assets, but this is a good kind of consistent measure. And so you can see, according to them, in 2020, about $35 trillion were invested in ESG strategies. And that's been growing at a good rate, well over 10–15% per year. The interesting thing, the thing that I've highlighted here is where this more recent growth has come from. Obviously, Europe has been traditionally a very strong area for ESG investing, but over the last 4–5 years, the biggest growth has been here in the United States. And you can see, it's basically doubled since 2016 to 2020, and I think it also rose very strongly in 2021. And so it's clear that this ESG interest has spread not just from Europe and traditional kind of European pension funds, but to the US as well. The other way of looking at it is the different kinds of ESG investing, and see what's been growing there. And this is from the same Sustainable Investment Institute. These bars show the total number of assets invested in different kinds of ESG methods in the past. And so this area here, norm-based screening, this is these exclusion screens, excluding sin stocks. And you can see actually the assets invested here have gradually been falling over the last few years. The growth has been down here, this area, ESG integration, where the assets managed under this kind of strategy have gone from 10 trillion up to $25 trillion. And so this is where the real growth has been, because people have been able to integrate ESG investing into standard investment approaches.
I see. So the approach, before this, it was more of weeding out maybe companies and stocks that do not meet ESG expectations. And as they do so, now they're getting more and more towards finding opportunities in ESG environment protection, preservation sort of opportunities. Great. Now that we've heard about the opportunities in ESG investment, what could be some of the risks of ESG investing?
Yeah, sure. I mean, there's various risks, and maybe we'll talk a little later about the kind of the performance risk. But if you look at it from a high level, from my point of view, there is two main risks. One is nobody really has a consistent definition of what ESG investing is, right? And so we've seen earlier on that there are various different approaches to ESG investing, and I think that's a good thing. There should be various different approaches. But the fact is, there's no universal ESG standards. And so what this means is some managers can claim to be ESG investing without actually doing anything on an ESG point of view. And we've heard of this word, greenwashing, where you pretend to be or make out that you're doing more ESG activity than you're not. And so without some kind of universal agreed standards about what is ESG investing and what is not, there's always the risk that you're going to invest in a fund and not get what you expected from an ESG point of view. I think that's probably the biggest single risk. The second risk down here is, ESG investing depends really on data to do it effectively. You need a lot of information about the companies beyond their basic financial information. You need to know, information about their production processes, their pollution, their legal lawsuits, a whole load of information about the companies. And this disclosure has got much better over the last few years, but the history of that data is very short. And so it's very difficult to come to clear conclusions about the long-term effect of ESG investing, simply because we don't have 20 years, 30 years of ESG data with which to test things.
Okay, so a lack of rules, standards, or guidelines, and also a number of years in order for us to form an opinion of ESG returns over the long run. Okay, thanks, Matthew. Now let us switch gear a little bit and take a look at the latest development in Ukraine. We have a second poll for attendees today. Okay, so we are asking, what is your outlook on Russia's invasion of Ukraine? Feel free to let us know. Okay, let's see the results. So, a third of our attendees are quite worried that it may escalate into something worse. Half of us are moderate worried, but majority of us fall in the concern spectrum. Then followed by less worried, the piece that will return soon, and not worried because it's not affecting us personally. So, Matthew, how do we make sense of this situation in Ukraine? Because Bloomberg report shows that ESG funds had $3.8 billion invested in Russia before the invasion. And Russia's invasion is really a sending wake-up calls to all of us about ESG matters, because we could be seeing a closer association between geopolitical risk and investments. And what does this also mean to other emerging markets where the data on ESG is not clear, the transparency and governance is not, the information about these things is limited. Are we worried, or should we be worried about emerging markets?
Yeah, and thank you. I think this is a very good point. So you mentioned that yes, ESG funds do have exposure to Russia. We've seen obviously the amount of ESG assets is very large, and so kind of from a percentage point of view, their exposure to Russia was not large. But it's clear that ESG investing didn't mean that you escaped from Russia exposure completely. So maybe let's look first at how some ESG funds have performed, during this crisis, and then maybe we can expand that to kind of other emerging markets, other countries, things like that. So if we start perhaps with this is a graph of two funds, one a ESG fund and one a non-ESG fund. And it's very important when you're comparing funds to make sure you're comparing like with like. And so what I've done here is I've chosen two ETFs that are both based on MSCI emerging market indices. And so the pale blue line here is the standard MSCI emerging markets index. And so there's an ETF listed in the US that tracks that index. And then the darker blue line is the MSCI ESG emerging market index. And so these are two indices, both made by MSCI, and they're designed to have very similar characteristics in terms of their industry exposure, their country exposure, that kind of thing. But the ESG one obviously is tilted more towards companies that have a high ESG score. And so first thing you can see, this is the performance of both of these funds over the last 6 months or so. Basically, they've performed basically the same, both in the lead up to the invasion of Ukraine, but also since the invasion itself. So there hasn't been any significant outperformance by the ESG fund, but equally it hasn't underperformed the regular fund. But I think if you dig a little bit deeper into what's inside these funds, you can see a little bit more of how they're exposed to geopolitical risk. And I think there are some differences there. This slide summarizes the exposures in the two funds. And so if we look from this side over here, this is just the exposure to Russia. This is at the end of December, so obviously before the Russian market closed. But at the end of December, both the regular emerging markets fund and the ESG tilted emerging markets fund had similar exposures to Russia, between 3.5% and 4% exposure. That's fair enough. And then on this side, we can see the exposure to the industries that they had in Russia. And they're very similar. The biggest single exposure from an industry point of view in Russia is energy. That makes sense. And then things like financials, banks, materials, metals, things like that. And you can see the industry exposures are very similar, and that makes sense. The big difference between the two is the number of companies in which they invest. And so for the regular MSCI Emerging Market Fund, they invested in 27 countries in Russia. Whereas after you've done some ESG filtering and tilted towards high ESG names, the ESG fund only invested in 12 names, 12 securities in Russia. So it cut out a lot of securities. And we'll see that this had a big impact, I think, on the geopolitical risk of the two funds. This is just some documentation from MSCI. It shows that they deliberately try to avoid companies with what they call headline risk. So these are companies that have, either controversial businesses, controversial ownership structures, links to politicians, things like that. And so you can see what it actually meant for the funds on this slide. What I've done here is I've taken all 27 stocks that are in MSCI Russia and split them. The dark blue ones here are the 12 that are also in the ESG Emerging Markets Fund. So these are the 12 Russian stocks with a relatively high ESG score. And The blue one over here, these are the pale blue ones are the Russia stocks with relatively low ESG scores. And then over here, I've compared these two different groups on a couple of different metrics that have a link really to geopolitical risk. Starting here, look at what percentage of them are owned by oligarchs. So this bunch of billionaires who own a large proportion of Russia. And they look very similar from that point of view. I think if you're investing in Russia, you can't really escape from that. Similarly, about a third of the stocks are owned by the Russian government. And that's just a factor of life in Russia. You can't get away from that. But the big difference you see here is the percentage of stocks where the owner of the company has been sanctioned, been subject to economic sanctions, either by the US or by Europe. And so in the case of the ESG names, about 40% of the owners have been subject to economic sanctions. But 80% of the other ones have been subject to economic sanctions. And so it's clear that the non-ESG names are having a lot more geopolitical risk simply because of the kind of person who owns them. Similarly, when you look at pollution, the non-ESG names have got way worse pollution records than the ESG names. And also, if you look in terms of kind of personal links to Putin, in terms of links from the owner to Putin or direct impact of Russian politicians on the firms, you can see that the ESG names have far fewer links to the Russian president than the non-ESG names. And so what I'm trying to get at here is, though, even though we haven't seen great differences in performance so far, the ESG tilted fund clearly has less geopolitical exposure than the general Russia funds. And up until now, I think all Russian stocks has been sold off. The Russian stock market has been closed for several weeks. And so it's natural that all Russian stocks get sold off. But you can imagine as the war draws to an end, that the stocks that have no sanctions on the owner, the stocks that are not linked to Putin, the stocks that are not heavy polluters may well rebound faster than the stocks that do have owner sanctions, do have links to Putin. It remains to be seen if that's the case or not. But I think it's clear that by tilting your portfolio towards ESG, in the case of Russia, you're able to not eliminate, but certainly reduce the amount of geopolitical risk, I think, in your portfolio.
Yes. And so, by removing the risk, will make the portfolio more resilient overall. Would you say so?
I think it has a good chance of being more resilient. I think, so the example here we've been looking at obviously is Russia, and this is the one in everyone's mind. But you can imagine this similar kind of thing being relevant in other emerging markets. You could imagine perhaps longer term tensions between the US and China, leading to potential penalties on certain Chinese-owned companies. And you can see that the ESG tilted portfolio may have lower risk, lower geopolitical risk in that area as well.
Okay, thank you. Well, I would be very interested to find out the performance between ESG and non-ESG investing. But before we go there, can I just encourage our attendees to ask your questions in the Q&A or chat box. We'll try our best to address them in the session later. Matthew, so would we say that ESG funds outperform its other counterparts during crisis time?
Yeah, so it's hard to be definitive. It's hard to say clearly exactly about this, but maybe we can look at some examples. This ESG fund, since the start of the Ukrainian tensions, you can look at it a little bit longer. For example, during since the start of 2020, which is from the start of the COVID pandemic, And so this is the same kind of graph. The light blue is the regular fund. The darker blue is the ESG tilted fund. And since the start of 2020, there's a slight difference in performance, but it's not material. So on this basis, we can't say that the ESG tilted fund has outperformed. But this is a relatively short window. This is just over, 2 years. If we may perhaps look at some longer term data, and in that case, we may maybe look at some other countries as well. For example, this is the equivalent funds for the US. And naturally, there's a longer history for ESG investing in the US compared to emerging markets. But this is the same data, same kind of data from MSCI. And the kind of orangish brownish line is their USA ESG tilted portfolio. And the kind of greenish colored line is their regular MSCI US index. And you can see this goes back to 2017, so it's a little bit longer, so 5 years of data. And you can see here, although they're highly correlated, they move in the same direction, but you can see over the period, the ESG tilted fund has outperformed the regular fund. Not by a huge amount, it's not like it's beating it by a large number of percent each year, but it's gradually, certainly since the start of the pandemic, it's gradually outperformed. And maybe later we can look a little bit about some of the drivers of this outperformance. But it's clear in this case, in the US, ESG investing has outperformed on this kind of measure. You can do the same thing, say, with China. MSCI also publish a ESG leaders index for China. And this graph, this one goes way back to 2007. And it compares the performance of MSCI's regular China index, which is the orange graph there, and it compares it with their ESG index. And you can see also, they're highly correlated, they move in the same direction, but the ESG tilted portfolio has outperformed much more than the regular one. It has a higher level of risk in the case of China. But it also has over this particular period, it's got a far higher return. So looking at EM in general, US and China, obviously it depends on the market and it depends on the period in which you're looking. But it's clear that over a long period, it looks like certainly ESG investing hasn't delivered lower returns than non-ESG. I think we'd say that's it.
Okay, so at this point, we already have an idea of what ESG investing is about, why ESG is in such a big demand, and what could be some of its risk, and also the key point about company screening in the ESG investing. Now let's talk about what all this means to us as investors. Matthew, could you just walk us through what could be some misconceptions that you already heard of or about ESG investment?
Yeah. Okay. Yeah. I think the biggest misconception is this idea that ESG investing will hurt your returns. That somehow there's a cost, a return cost in ESG investing, and so if you tilt towards ESG, it means you're going to have lower expected returns. That's not our belief. We believe that ESG tilts don't have any real difference on your expected returns. And so maybe let's look at a little bit of the evidence for it. And so this also is from MSCI. This is some research that they did where they split their investment universe into what they call top tier, middle tier, bottom tier. So top tier are, from MSCI's point of view, names with a high ESG rating. Bottom tier is names with a very low ESG rating. And then they look at the average of these different groups on various different metrics. And this is a kind of a fundamental measure of how fast the earnings are growing for these companies. And so on this data, based on MSCI's data, you can see that relative to the benchmark, top tier, high ESG rated names have got earnings growth of 2.9% more than the benchmark. So according to MSCI, the earnings grow faster for good ESG names. And you can see here, their bottom tier has got -9%, so 9% slower than the benchmark in terms of earnings growth. And that's a big spread. That's a big difference in earnings growth. And then you can see here, this is in terms of active return relative to the benchmark. According to MSCI, good ESG names have outperformed by 1.3% relative to the benchmark, and bad ESG names have underperformed relative to the benchmark. Obviously, this is MSCI's data. This is their analysis, but I think they've done it in a good, robust way. There's also some good academic analysis about this. This is from an academic paper that was published in 2015, and what's good about it is these guys looked at 2,000 different studies of ESG and tried to see if overall these studies had evidence that ESG outperformed or not. And they certainly found that in most cases, there's no evidence of a negative impact from ESG. They didn't find any evidence that ESG hurts your returns. And then they found, and this bit I've highlighted here, they found that in most of the studies that they looked at, there was a positive impact from ESG. So we've seen from the point of MSCI, who's really a market data company, and from the point of view of academic research, your performance. Finally, this is an interesting one that Morgan Stanley produced. What they did was they looked at US mutual funds since the start of the COVID pandemic, and tried to see whether ESG mutual funds have done better than regular mutual funds. And their conclusion here is that during the period of COVID, so over the last 2 years or so, ESG focused funds, they're calling them sustainable here, but they're ESG funds, have outperformed their peers, their traditional funds, by about 4%, which is a big difference. So it looks, at least in the US, as if ESG funds have outperformed, but you have to dig a little bit deeper. This is showing the exposures in these funds, where these funds invest. And you can see here, the sustainable funds, the ESG funds, are more tilted towards large cap stocks in the US. And they're more tilted to growth stocks in the US. And that's quite a common pattern that you see. Large companies tend to have enough resources to be very active in ESG and do the right kind of things from an ESG point of view. And so it's natural that an ESG focused fund will have more assets in large cap companies and more assets in growth companies. But the fact is, over the last couple of years, in the US at least, large cap growth companies have been the companies that have outperformed. And so ESG funds, because they have a tilt towards those kind of stocks, they've outperformed as well. So it's easier saying ESG has outperformed over the last 2 years. The fact is, ESG has been tilted towards large cap, tilted towards growth, and it just happens that those two have done well. So there's certainly, as I said, there's certainly no evidence that ESG tilts have hurt people's performance over the last COVID period and over the longer period. But I would be careful about saying that ESG investing is going to actively increase your returns.
Okay. So say if I'm now interested in ESG investing, where should I begin looking for good investment opportunities? I mean, in Malaysia, I mean, we have seen quite a lot of unit trust funds on the ESG team, these actively managed funds. But we also know we have options in ETFs, which are index funds, passively managed. How should we compare between these two, Matthew?
Yeah, sure. I think that's a very good question. Yes. And this is a question that we have in other markets as well, in the US and in the UK as well. And so a lot of ESG funds tend to be active funds. And so the asset manager deliberately tries to choose companies that have good ESG scores and that he thinks are going to outperform. And I don't think there's anything wrong with that approach, but I would say it's very difficult because the manager has to be able to do two things very well. He has to be able to identify good ESG stocks. And, that's not obvious. That's not easy. But then he's running an active fund. So he has to be a good active manager as well. He has to be able to also choose stocks that are going to beat the benchmark. And both of these things are very difficult. And so to be able to do both of these things in one fund, I would say is really very difficult. Not impossible, but difficult. And so our approach is much more along this ETF-based approach. With MYTHEO, we've been running a ESG strategy for the last 6 months or so. And we use a more risk-controlled approach of using ETFs that still track regular indices, but are tilted towards ESG. And so they're not active funds, they're index-based funds, but they have a tilt towards ESG. And so you can see this is our MYTHEO Global ESG strategy, and you can access this from the regular MYTHEO homepage. In terms of how you can set it up, it's very easy to set it up. You can simply go to the regular MYTHEO homepage or the MYTHEO app and open a new portfolio, create a new portfolio, and just simply select here to start investing in global ESG. And then MYTHEO will go and build you a growth portfolio of ETFs that are all ESG focused ETFs. It'll still be a very diversified portfolio. It'll still invest in global equities all around the world, but all of them will be ESG focused. And so you can see these are the kind of securities, the kind of ETFs that are in the MYTHEO Global ESG portfolio. And as you can see, there's US-based ETFs, there's EM ETFs, there are European ETFs as well, but they're all tilted towards ESG. So these are not, as I said, these are not active portfolios. They're risk-controlled, index-based portfolios, simply tilted towards stocks that are relatively good from an ESG point of view. I think this is one way of getting ESG exposure into your portfolio without taking this big kind of active risk of potential underperformance by the active manager. I think this is a very kind of rational way of doing it.
Okay, Matthew, we do have a few questions from the audience that is quite related to what you're saying there. Let me read out the first question. Could you please comment on how MYTHEO manages our investments? As recently, there is also other robo-advisor which caught the wrong timing due to ad hoc human intervention. Yeah, on the comments about human intervening in investments versus robo-advisory.
Sure. Yes, certainly. Yeah. Obviously, I can't make any comments about other investment managers. I don't know the details, but I can reiterate how MYTHEO manages money. All of our strategies are model-driven. All of the decisions are driven by the model. There's no kind of human overlay, human discretion on individual stocks. But also, all of the MYTHEO strategies, both the ESG strategy and the regular MYTHEO strategy, these are all long-term investment strategies. We're not looking to try and time particular markets, time particular sectors, and things like that. And so you'll see if you look at a MYTHEO portfolio, the turnover is relatively low. It's not like we're jumping into a particular sector for 6 months and then jumping out again. You know, we do change the positions through time as market conditions change, but we don't make drastic decisions, drastic changes to portfolios from month to month. That's a very difficult thing to do, to try and time individual markets, time individual sectors. Very difficult to do properly. With MYTHEO, we simply take a much more long-term investment approach and make the decisions purely on the basis of our models rather than any kind of human overlay.
Right, so avoiding timing the market in the short term through human intervention. The second question relates to the geopolitical risk. What would MYTHEO's algorithm do when there is a large drawdown in investment?
Sure. Yeah. So there's a couple of things to put on here. Within MYTHEO, risk control is the core of the portfolio. And the basis for this is it's very, very difficult to predict returns. It's very, very difficult to predict whether the US is going to outperform China next year or whether Europe is going to outperform next year. Very, very difficult. But it is relatively easy to predict the risk of different markets. You can look at the in the markets. So you can measure the risk of different markets. And that's the approach that MYTHEO takes. So for example, in our growth portfolios, our portfolios are built to be investing in equity. So investing in relatively high risk asset class. Equity is a relatively high risk asset class, but within that, trying to produce the portfolio that has the lowest overall risk as possible. If you're investing in equities, you can't escape a certain level of risk. That's fair enough. But given that, try and select the group of securities, the group of ETFs that gives you the lowest overall risk. And so geopolitical risk is an element of that. And that's included in the risk calculation. The other element is this AI assist element that we do have in MYTHEO, which looks at the market participant view of risk for each market. And we use some market data that's based on market commentary, news, items on Bloomberg, reports about different countries, and try to see whether the people who are investing in these countries sense a large spike in risk in that country. And we use a proprietary AI algorithm to measure that. And where that AI algorithm identifies countries with a large upturn in risk, then MYTHEO will naturally reduce position in those kind of countries. But as I said, all of this is model driven. It's not like we have somebody sitting at a desk making a decision to pull out of a particular country or pull out of a particular market. This is all model driven. Sometimes the model gets it right, sometimes it doesn't, but there's no element of human overlay in there.
Okay, so using AI to control risk, be more sensitive towards the sentiment, and really minimize human bias and misjudgment. And that's something that we don't have in MYTHEO. So you mentioned about growth portfolio there just now. So what, in terms of allocation, how much should an investor invest in ESG theme versus the growth portfolio that you mentioned there just now?
Yeah, sure. So this is very much a personal decision, how much you want to allocate to ESG. As I've said, from MYTHEO's point of view, the expected return of our global ESG portfolio in the long run is the same expected return as our growth portfolio. So we're not expecting one to outperform the other. Obviously, month by month, the returns will be different. But in the long run, we expect the ESG portfolio to give the same level of returns as the growth portfolio. But one approach that many people take, especially institutional investors, is this kind of core satellite approach. And I think this is a very sensible approach to take. The idea is you have a core of your portfolio that's very stable and based on long-term asset allocation. And then a satellite which can be more active, more alternative kind of strategies. And the kind of relative ratio between the core and satellite depends on the investor. A very common pattern is 80-20. So 80% in the core strategy. So this would be your basic MYTHEO strategy. And MYTHEO will give you an ideal asset allocation for that core strategy. But then if you really want to participate in ESG investing and you'd like to invest in companies that are having a positive return in society, perhaps allocate 20% of your portfolio to this satellite ESG element. I think that's a very reasonable way of approaching it.
Okay, so 80-20. We do have a few more questions from the audience. Thanks for putting them up. We'll address them. There's a question about cryptocurrencies or NFT being part of ESG investments. Do you see this newer investment vehicles be part of the ESG universe?
It's a very good question. Yes. I would say long-term, yes, but we're still quite a long way away from that. If you take cryptocurrencies for a start, the cryptocurrency market is still at a very early stage. It's still very opaque. It's very, in many cases, it's not clear exactly how a particular cryptocurrency works. And so I think there's still a level of transparency for cryptocurrencies that's not there. But you could imagine in the longer term, if they are more disclosed about like how the cryptocurrency works and whether there is any link to companies with a positive ESG impact, then you could imagine them being incorporated into an ESG strategy. But as I said, I think it's still a long way away. If you think about like where ESG strategies are right now, is they've become very common for equity investing. So we saw, $35 trillion in ESG assets, mostly in equities. They're slowly getting more into bond portfolios, but still, the number of kind of green bonds, ESG linked bonds is relatively small compared to the overall bond market. And when you think about real assets, still ESG investing is still at its early stage there. So I would expect, the gradual transition to be from ESG investing in equities through to bonds, through to real assets. And then the next stage might be to things like cryptocurrencies or NFTs. So I would say there is potential for them to be incorporated into ESG investing, but it's still early days in terms of the availability of data. Yeah,
I see. So still an early days. We have another question. I'm worried that so many factors are going around with the Fed rates, Federal Reserve rates, inflation, geopolitical. Would 2022 be a slower year or a slow year in terms of investment for all of us?
Sure. Okay. I think many of us have the same kind of concerns. The headlines are quite frightening, right? US inflation has spiked up to levels that we haven't seen for 30, 40 years. The Fed is talking really quite aggressively about raising rates starting this year and going through next year and the following year. And also other countries as well. I think two things to say, one is risk is always present in investing. And while I can't say whether, whether 2022 is going to be a good year or a bad year, I don't know. I don't think anybody really knows. But it's true to say that the risk is always there in investing. This idea that you should wait until things calm down and until things become more clear. The point is, these risks never go away. They'll change. In 6 months' time, there'll be other risks to worry about. In 12 months' time, there'll be other risks to worry about. They might not be the same risks as they are right now, but there'll be risks there. And so this idea that risk will go away and then it's safe to start investing is very dangerous, I think. If there's no risk, all you're going to get is the risk-free return, which is very, very small. And so investing, in particular investing in equities, means accepting some risk. The other point I'd make is just how difficult it is to forecast returns. I don't think anybody in 2021 expected the US market to go up, 20-25% in 2021. If you'd asked people at the start of 2021 that you're in the middle of COVID, what do you think is going to happen to the equity market? Nobody would have predicted that. And so I think we will be surprised in 2022 by returns, but I can't make any prediction about, which particular markets.
Okay, right. So we have our last poll for our attendees today. Let me launch the poll. So we're asking, how likely will you now consider adding ESG into your investment portfolio? Taking into consideration what ESG is, the risk, the idea of screening out companies that do not meet expectations. Let's see how our attendees respond to this poll. We'll just give it a couple more seconds. We have a few attendees not responding yet. Please do. Feel free to let us know. Okay, let's see the results. Yes, I think that's quite encouraging. I think great majority are now actively looking for ESG opportunity, but at least they're not negative towards ESG. Some do say that they prefer to wait and see. Leave us comments what could be some of the indications that they're waiting for, and we'll try and see if we can address them. And we also have attendees who are already invested in ESG. That's quite optimistic, Matthew, would you say? Okay, I think we lost Matthew there. Not to worry. All right. So, with that, I think we should wrap up the discussion today. I'll just leave you guys with these thoughts. Factors that cause asset prices to fluctuate are diverse, fluid, and more importantly, it's quite hard to predict. Our message to you is to think about building resilience in your portfolio. And as we've seen today, ESG investments compared to non-ESG ones, it seems to outperform even during the COVID period, and also during this time of geopolitical risk and tensions. We think that if you could consider adding ESG investing into your portfolio, you can minimize exposure to companies who do not operate sustainably. Now, this is very important, as Matthew shared earlier on, because fund managers, including sovereign wealth funds, they are screening companies more closely today, removing those who do not meet ESG expectations. And finally, we would urge you to take action today, understand how ESG can further diversify and improve your overall investment performance. So head on to MYTHEO's app, website, learn more about our ESG solution, go to our social media, drop us a message, let us know if you have any further questions, and we are always ready to address them. I think Matthew is not back on the line, but in any case, I would just want to thank Matthew, as always, for the great insights and for helping us see more clearly the ESG investment and how it can help us build resilience during these tough and trying times. With that, I'd like to thank you once again for your time today. Hope to see you in our next webinar soon. Take care.
Let's take a moment to talk about money. We all know how important it is to save. But no matter how hard we work to build our nest egg, experts believe most of us still won't have enough to retire comfortably. Investing is the better way to grow your wealth, but requires years to master on your own, or high fees and starting capital to hire a wealth manager. Now, there's an easier way for you to invest. MYTHEO is a digital investment manager that does the work for you using investment strategies with a proven track record, helping over 60,000 Japanese investors grow their wealth. That's over $300 million of assets under management. And this is all it takes to start investing meaningfully. When you create an account, MYTHEO will want to know you a little better. Things like your age, assets, and appetite for risk. Once it has collected enough information, a professional investment portfolio will be generated just for you. This portfolio will consist of ETFs listed in the US stock market. Each ETF is selected for its different feature, such as country or asset class, to further diversify your portfolio, and that disperses some of the risk. This global diversification strategy is one way MYTHEO optimizes your portfolio. The algorithm that drives MYTHEO's logical investment reasoning is based on the research behind 2 Nobel Prizes. In the past, you or your fund manager would have to closely monitor the market's various moving parts every day. That's a lot of data and decision making. With MYTHEO, you don't have to sweat the hard stuff. It automatically rebalances your portfolio to its prime investment position. What MYTHEO does for your portfolio is no secret. View the rebalancing data anytime from your account, accessible via the app or website. You might even want to start calling the shots one day. Go ahead and adjust the portfolio to suit your needs. After all the money talk, here comes the money talk. Thankfully, MYTHEO's service will not break the bank, just a small fraction of your investment. With no sales fee, no exchange commission, and not a single surprise charge. So the question to ask yourself is this: will it be worth it? Deciding to invest may mean new commitments and lifestyle adjustments. It could also mean the freedom to do what you've always wanted, not just life's milestones like marriage, kids, and retirement, but the moments in between that make life richer. Whatever it looks like, it's time to invest in experiences that truly matter to you, because life's moments are priceless.